Hello everyone, welcome to another episode of the Commercial Real Estate Contrarian. If this is your first time tuning in, as always I encourage you to go to the intro video that I put out that tells you a little bit more about this channel. The short version is that I think that our industry is basically filled with a bunch of uneducated idiots, and there is a overabundance of risk that is being taken because most investors, certainly brokers, property managers, etc., just do not understand the fundamentals of finance or returns or understand how to properly analyze deals. So my goal is to help the industry. I am not trying to sell you anything. I am remaining anonymous because I am in the industry and I don't really want people knowing that I'm calling them idiots. So again, I'm not trying to sell you anything. I'm not trying to sell you spreadsheets. I'm not trying to sell you a get-rich-quick program. I'm trying to help you understand commercial real estate and how to value it properly. What I want to talk about today is the long-term single-tenant triple net investments that have been pretty popular. They're great among the 1031 exchange crowd, where people basically, overpay for real estate assets, and they think that they're safe bonds and just appreciation, and nothing can ever go wrong. Well, the last year, the shit has hit the fan. We're in a credit crunch. The 10-year Treasury is up, wildly, as everybody knows. SVB bank collapsed because of the Treasuries. So I just want to show you, like real time, what has happened, and I want to go through a deal real quick. This is a half made up, but half real deal. I mean, these deals happened. And there was a couple that traded. These are single tenant Amazon facilities. And this could be a single tenant Kentucky Fried Chicken. This could be a single tenant bank branch, whatever. But in this particular case, I'm just going to go over a single tenant Amazon distribution center. So here's some metrics, and these are real time. Let's say that you purchased this property in January of 2021. The average 10-year Treasury yield in January of 2021 was 1.08%. That is amazing. I mean, good grief. To think about a 1% 10-year Treasury back then is crazy. You felt that you were getting a great deal because you bought that at a 4% cap rate. That's 200, it's almost 300 basis points over the risk-free rate of the 10-year Treasury. So you're like, great, my tenant is Amazon. I'm buying at 300 basis points over the 10-year spread. If I went and bought Amazon bonds back then, Amazon issued some, I think, 7-year bonds in January of 2021. The rate they were paying was 1.65. So you're like, great, I'm getting an even bigger spread over their bonds. So like everything is great. So the building is 500,000 square feet. They're in there for 10 years, and there's 2 5-year options. They've got 2.5% in lease escalations. So fantastic. This $8 net rent that they're paying me, 2.5% a year. So here's what that looks like over a 10 to 11 year period. End of year one, I got $400,000 in NOI. That's the 500,000 square feet times the $8 a square foot. And then that grows at 2.5% interest, or not 2.5% interest, that grows at 2.5% over the next, 10 years. And then if they exercise their options over the next 20 years, right? Now I paid a 4% cap rate, okay? Right here, 4%. So that means that I paid $102 million for this building. I paid $100 million for the building, which is $200 per square foot. So forget about leverage for a second. It's irrelevant to this discussion. But I paid $100 million, $200 a foot. These are real deals. These deals actually happened across the country. So everything was good. At the end of year one, okay, so January of 2022, or December of 2021, cap rates were, let's say the cap rates were still 4%. So if I wanted to sell it at a 4% cap rate, my NOI, my next year's NOI is $4.1 million. So I can sell it for $102.5 million or $205 a square foot. Great. All is good. But then what has happened? What has happened throughout 2022, 2023? We had a credit crunch. 10-year treasuries went from 1.08% to now 4%. So cap rates are now, my year two cap rate is now 6%, not 4%. So if I had to sell this building today, I am going to look at next year's NOI, which is $4.2 million, divide that by a 6 cap, and now I can only sell that in today's market for $70 million or $140 a square foot. I just lost 30% of value if I truly mark my asset to market. Okay? Now, you might say, hey, listen, I bought this for 10 years. I don't plan on touching the money. I'm comfortable with the NOI that I receive and the cash flow that I receive. And I don't care about the terminal value because, I don't plan to sell it. Okay, that's fine. Let's play it out to 10 years. Let's say that our cap rates today are at 6%. I don't know if they're going to go back down. I don't know if they're going to go back down to 4%. I don't know if they're going to go up to 7 or 8. Let's just say that they stay the same. So it's 6% is my cap rate throughout the entire hold period. But look out here in year 10. Like in year 10, I'm capitalizing $5.1 million at a 6 cap. And 10 years from now, I can only sell for $85 million or $170 a square foot. I'm still down from where I bought it at $100 million today. So look at the unlevered, again, forget about leverage for a second. Let's look at the IRRs in over a 2-year period. If I had to sell this, if something happens in my life and I have to sell this investment after year 2, I just lost 12%. 12%. Then it gets a little bit better as I go down, but look at this. I mean, even in a 10-year hold situation, my internal rate of return is barely 3%. It's horrible. So let's just say that I'm being too aggressive on my adjustments to cap rates, and you're like, look, cap rates really aren't 6%; they're 5%. Okay, 5%. Okay, I'm still, after 10 years, only earning 4.6%. That's a horrible real estate deal. Think about inflation. Good grief. Let's say that it's the other way, though. Let's say that it's 7% is my year 2 cap rate. It just keeps getting worse. So what I'm trying to get to is that there is inherent risk in commercial real estate. This is an illiquid asset. If you had bonds, if you had the Amazon bonds, the debt bonds, instead of the real estate, you would have been able to sell those overnight and maybe take a little bit of a loss, but certainly you wouldn't be stuck in a property that is illiquid. Yeah, you can put it on the market and sell it, but that's going to take 6 months. So people need to understand that when they're buying these single tenant long-term deals, it is just, and when bonds fluctuate very, very quickly like they have, that can be very, very bad news for investors in commercial real estate. If you disagree, let me know. If you agree, let me know. And I'm sure that there's going to be people that are like, oh, well, I take depreciation on it and this, that, and yeah. I get it. Got it. Okay. I never want to buy a piece of real estate to lose money just so I can get depreciation on it. That's what happened in the 1980s, and that's what led to the savings and loan crisis. So that's my 2 cents. If you disagree or want to add something, let me know.